Okay. So, guys, today we'll make a balance sheet and income statement from scratch, and then we will prepare the cash flow statement. Then I will tell you, I'll give you only the income statement and the balance sheet, and from that income statement and balance sheet, you have to prepare the cash flow statement. So, it will be very interesting, especially for those who are from the non finance background, from finance, from science background, or from arts background. Now, the goal is that, if I tell you this, things would get crystal clear with respect to financial accounting, right? How the balance sheet is made, how is the income statement made, what goes into the various line items in the balance sheet. Those things would get clearer with today's topic. Okay, so guys, uh, basically, guys, say we start a company with 10 lakh cash, right? So let me wait. Is the screen visible? Can you see the screen, everyone?
Yes, sir.
Okay. So we start a company with 10 lakh rupee cash, right? Start with cash. So you just started your business, right? So the opening balances of all the accounts would be zero, right? You start the business with 10 lakh rupee cash. Okay. So basically you are the promoter of the company. So the company would issue equity shares worth 10 lakhs and you would pay the company 10 lakhs, right? So how this happens is that the company would issue you common equity shares worth rupees 10 lakh, and in lieu of that, you would pay company 10 lakhs in cash, right? So cash 10 lakh and equity is also 10 lakhs. And by contributing this 10 lakh rupees, the you become 100% owner of the company. You are the only shareholder of the company. You become the 100% owner of the company. You own all the equity in the company. Okay. Now, guys, we take a loan at the rate of 1%. ठीक है ना? We take a loan of say 5 lakhs. ठीक है? So we'll record this loan as a liability on my balance sheet, and my cash balance would increase by the amount that I have borrowed. Right. So let me just. This is the liability side total. This is the asset side total. Okay. Guys, next you purchase goods worth 1 lakh on credit. Purchase goods on credit. Okay. So guys, please tell me, how will this affect my accounts? Guys, how will this affect my accounts? Chalo, tell me really fast.
Accounts payable,
Yes.
creditors.
Very good. So first, since we've purchased goods, our inventory would increase by the amount of goods purchased. And since I've purchased them on credit, I'll create an accounts payable account, right? Of and I'll report it at 1 lakh. Right now, what is my accounts payable? Payable account reports what we owe to our vendors, what we owe to our suppliers, right? So I purchased inventory worth 1 lakh. So my inventory balances would increase by 1 lakh. And since I've purchased them on credit, I'll report an accounts payable of 1 lakh. And accounts payable basically records what we owe to our vendors, what we owe to our suppliers. Okay. Now, guys, I purchase a plant and machinery by paying cash in cash. Useful life of this plant is 20 years, and salvage value of this plant at the end of its useful life is zero. Right? Okay, so since you've purchased this plant and machinery in cash, first I'll record a plant and machinery in my balance sheet. I'll report a plant and machinery at cost, right? And I'll reduce my cash balance by the same amount since I've paid in cash. Right, guys, keep noticing my balance sheet total should always tally. And also notice every transaction, every transaction is affecting two accounts. Keep noticing this. Accountancy is basically telling you that each account, each transaction would affect two accounts, right? So each of these transactions here would affect two accounts, right? And the second thing, please notice that the liability side and the asset side total would always equal after I have adjusted the transaction in both the accounts. Okay. Now, guys, uh, goods costing 50,000 are sold on credit at a price of 1,25,000. Right. So you are a good salesman. You need to you understand how to fool your customer because customer के नाम में ही होता है क्या होता है बोलो
Customer.
मर ठीक है ना
Customer.
कस्टमर के नाम में ही है कि मर जा जाके so you made a fool out of your customers. Goods costing 50,000 you were able to sell him at 125, right? You sold on credit. अब कौन मरता है तुम मरता है कि कस्टमर मरता है वो भगवान जाने वो एक he bought it at 125 maybe he won't, and he bought it on credit so maybe if he does not repay you क्या पता you मर or he मर, right? So that only time will tell. Okay, so guys, since you made sales of 1,25,000 in the income statement you'll record a sales of 125 and cost of goods that you sold is how much 50,000. Okay, so let me report a net profit here somewhere, although this is my gross profit but I'm ignoring that for the time being. So my sales minus all the other expenses that I'll pass through my income statement would become my net profit, right? And I'll total this up. Okay, so and guys my net profit would increase my retained earnings, right? So let's do this here. Let me create a call return row retained earnings and let me plug in the profit figure here, right? So guys, every time the profit will change my retained earnings balances would also change. Okay, now guys, uh, how will this transaction affect my balance sheet?
Inventory will be down by 50 and account receivable 1
Yes,
lakh 20.
since I've sold inventory worth 50, right, I'll reduce my inventory balance by 50,000. Sorry, by 50,000. And since I've sold good on credit, since I've made a credit sale,
Account receivable.
we report an accounts receivable of 125. Basically, accounts receivable records what our customers was, right? So you can see that the balance sheet has tallied. Okay. So keep noticing this, guys. Your balance sheet should always tally after I have, after I have given effect to the affected accounts. Okay. Now, guys, we pay cash to our suppliers. How much cash do we pay to our suppliers? Say 20,000. Okay. So which two accounts would be affected? First,
Account
my
payable will reduce.
yes, first my cash balance would reduce by 20 because I've paid cash to our supplier. I've paid 20,000 cash to my supplier, so my cash would reduce by 20,000, and my accounts payable would also reduce by 20,000. Right. So this basically means that by paying cash to suppliers, uh, wait a second, guys. This is wrong here. Loan is 5 lakh and accounts payable is 1 lakh. Okay, because I cut, copied, paste, right? That was a mistake here. Okay. So my accounts payable would reduce by 20,000. Okay. So by paying cash to our suppliers, what we owe to them reduces, right? That is why I'm deducting this 20,000, because once I paid my suppliers 20,000, what I owe them reduces. Okay. Okay, guys. Now we receive cash received from customers. How much? 50,000. Okay. So how will which two accounts would be affected, guys? First, my cash balance would increase by 50,000 and my accounts receivable would reduce by 50,000,
50.
right? Because since our customers have paid us what they owe us reduces, so that is why I'm reducing the accounts receivable by 50,000. 50,000 is the cash that I have received from my customers. Okay, so my balance sheet is tallying. Thank God. Okay. Now, guys, what would be the depreciation on this plant and machinery if we calculate depreciation on a straight line basis?
1 lakh.
No, so the purchase, we cost of plant and machinery is 5 lakh, useful life is 20. So salvage value is 0. So it would be depreciation expense every year would be how much? 5 lakh by 20. That is 25,000.
25,000.
Okay. So guys, we expense this depreciation in the income statement, right? So depreciation worth 25,000 would be expensed in the income statement. And once I expense this in the income statement, guys, my net profit would reduce to 50 and my retained earnings would also reduce to 50. Right, so you can see my net profit reduced to 50 and so did my retained earnings. Okay. Okay, guys. And guys, we also reduce the balance of plant and machinery by the amount of depreciation. So remember, under the cost model, fixed asset was reported at original cost minus accumulated depreciation. So 5 lakh is my original cost, depreciation is 25,000. Right, so I'll deduct this 25,000 from my plant and machinery. Right, now the carrying value of plant and machinery would be 475. Okay. Now, guys, salary due for the year is how much? Say salary due for the year is 25,000. Right, and actual salary paid. So we did not pay 25,000. We paid only 20,000. Right. Salary due for the year was 25, but we paid only 20. So unpaid salary is how much? 5. Okay. बहुत जल्दी आ गया ठाकुर. Okay, guys, now we'll report a salary expense of 25,000 in the income statement. Guys, please understand this. There is something to note here that we are reporting a salary expense of 25,000 in spite of paying 20,000 in cash, right? So salary paid in cash is 20,000. So we are reporting a salary expense of 25,000 in my income statement in spite of paying 20,000 in cash. Now guys, why is this so? Why are we reporting a salary expense of 25 when we are paying only 20? Any idea guys? Please tell me.
Because of Akira
Accrual
Very
based
Akira
good.
based.
application.
This has to do with the accrual method of accounting, which says that expenses are recognized when they are incurred and not when they are paid in cash, right? So, guys, I expense this 25,000 in the income statement. My net profit reduced to 25,000, and the reported value of retained earnings in my balance sheet is also 25,000. Okay, guys, this unpaid salary is recorded as a liability in my balance sheet. Why? Why is it reported as a liability in my balance sheet? Because unpaid salary is an obligation which the company has to pay in the
Okay.
future, which the company has to satisfy in the future. And guys, my cash balance would reduce by the amount of salaries paid in cash, which is 20,000, right? Cash balance would reduce by the amount of salary paid in cash. So you can see that the balance sheet is tallying after all these adjustments. Okay, guys, now interest on debt. Interest on debt is 1% of 5 lakh, which is how much? 5,000. Now, guys, interest paid in cash is, say, we pay only 3,000 cash, and the unpaid interest is 2,000. Guys, now we'll expense the interest on debt in the income statement. My interest on debt is 5,000. Unpaid interest would be recorded as a liability. Same treatment as the salary one. And my cash balance would reduce by the amount of interest paid in cash, which is 3,000. Right? Are we good, guys? See, my balance sheet is telling everything is okay. Are we good?
Yes, sir.
Good, sir.
Now we'll prepare the cash flow statement. Right? Now we'll prepare the cash flow statement. So, first part of my cash flow statement, or the first thing that is reported on my cash flow statement, is cash flow from operations. Okay. So, what would be the parts of, now we are using the direct method. Please note that we are using the direct method today. We will understand how to prepare the cash flow statement using the direct method. Okay, so the direct method basically identifies the uses of cash and deducts it from the sources of cash. So first, source of cash. Okay, first source of cash from operations is what, guys? Cash received from customer, which is how much? 50,000. Now we'll identify the uses of cash. Now guys, please remember, sources of cash would be reported as a positive number and uses would be reported as a negative, because source is an inflow, use is an outflow. So source is reported as a positive number, use would be reported as a negative, because source is an inflow and use is an outflow, right? So uses of cash. Cash paid to cash paid to supplier, which is how much? 20,000. Then salary paid in cash is also an operating outflow, right? It's also an operating outflow. Interest paid in cash is also an operating outflow, right? So these are my uh, various operating inflows and outflows. Now guys, my CFO would be 50,000. Basically, if I add these all, okay. So my CFO or operating cash inflow is 7,000. Okay. Now guys, let us calculate CFI. Please tell me what would be the CFI here, or investing cash flow.
Purchase of plant.
Plant and machinery.
Yes. Purchase of plant. How much did we pay to buy the plant? 500,000. So this is an outflow of cash, right? Since we've purchased it, we must have paid money to purchase it. We must have paid cash to purchase it. So this purchase of machinery is an investing outflow, right? So my CFI is minus 5 lakh. Last but not the least, CFF or financing cash flow. Okay, guys, what would be my financing cash flow? Please tell me.
Interest on
Based on loan.
Guys, my equity capital increased by 10 lakhs, right? When I had started the businesses, I had started the business, all balances were zero, right? All balances were zero, right? So my equity capital increased by 10 lakhs, right? Because I brought in 10 lakh into the business, and my debt also increased by how much? 5 lakhs, right? So uh, my equity capital increased by 10 lakhs. So inflow from equity financing is 10 lakhs. And my debt increased by 5 lakhs. So inflow from debt financing is 5 lakhs. So my CFF is 15 lakhs. Okay. Now guys, we'll reconcile the opening and the closing back cash balance. My opening cash balance is 0. Why? Because I started the company in this year itself, right? I've just started the company, so my opening balance of cash is 0. To that I add CFO, which is 7,000, CFF, which is how much? Minus 5 lakhs, and I no CFI, sorry, this is not CFI, and CFF, which is how much? 15 lakhs. Now guys, if I add these four numbers, I would get the closing cash balance. So if I add all these, what I get is, how much is this guys? 10 lakh 7,000. So let me check, my closing cash balance is 10 lakh 7,000. As you can see that my closing cash balance is 10 lakh 7,000. So guys, this is how your income statement is made from scratch. This is how your balance sheet is made from scratch, and this is how you use the cash flow statement to reconcile the opening cash balance and the closing cash balance, right? Now the cash flow statement is telling me that due to the primary business activities of the company, cash flows of the company increased by 7,000. Due to the investing activities of the company, cash flows of the company reduced by 5 lakhs. And due to the financing activities of the company, cash flows of the company increased by 15 lakhs. Right. So this is what my cash flow statement is telling me. Guys, any doubts, please? Is anybody having any doubts here?
No, sir.
No,
Now,
sir.
guys, now tell me, say I don't give you all these figures on the left. Right here, I narrated to you what happened during the year. Right, I just told you that this happened, this happened, this happened, and then we constructed the income statement, the balance sheet, and we looked at all these transactions to prepare the cash flow statement. Just for a second, just think that we don't know all this. The only thing we have is this. Now our goal is to prepare the cash flow statement using this data. Right, I have hidden all those data that I narrated to you. Now you have to prepare the cash flow statement using this data. How will you do this, guys? Now again we'll use the direct method. How will we do this? Guys, I've hidden all that data, and this is what you are actually given in the real world. This is what you are actually given in the real world. Nobody is going to tell you what happened during the year, how much cash was received, how much cash was paid, how much interest was paid in cash. No one is going to tell you all that. You have to find that out on your own, right? So we have to we have to prepare the cash flow statement using the balance sheet and the income statement alone, right? So how will we do that, guys? Should we start?
Yes, sir.
Okay, so first we need to calculate.
Sources of cash.
Yes. So where was that PPT? So this was my direct method. So first thing we have to calculate is your cash collected from customers, right? How do we do that? कहाँ गया Excel? Okay, so first you calculate cash collected from customers. So for that you
See,
need to go where, guys? Please tell me.
see, income statement
No, first
and the
you need
and
to
Account receivable.
if you reconcile the opening and the closing balance of accounts receivable, you can calculate the cash received from customers, right? So opening balance of accounts receivable. Now the opening balance has to be zero because we've just started operations. This is the first year of operations. Add sales, add sales because sales is going to increase what our customers owe us, less cash received from customers. So we don't know this, we have to find this. This is the missing number. Okay. And if you add sales, deduct cash received, you get the closing balance of accounts receivable. Closing balance of accounts receivable is how much, guys? 75,000.
75,
Now, guys, please calculate what should be the cash received from customers.
50,000.
50,000, right? 125 minus 50 is 75. So we've got the first thing, which is, so here I'm writing uh, cash flow statement, CFO, sources of cash received from. संकोच शिवाशीष कोई डाउट तो नहीं आ रहा है?
No, sir.
No, sir.
सब समझ में आ रहा है कि नहीं?
Yes, sir.
RS.
So cash received from customer is an inflow. So that is why receiving we are reporting it as a positive number. Okay, now the next thing we need to calculate is cash paid to suppliers, which is a use of cash. Okay, how will we calculate the cash paid to suppliers? I told you that we need to investigate two accounts, right? We investigate two accounts here. So first we look at the inventory account to calculate the purchases during the year, because purchases is not reported on the face of the income statement, neither is it reported on the face of the balance sheet. So we first reconcile the inventory account to calculate the purchases for the year. So opening balance of inventory is nil because we just started business. Add purchases, right? Because the amount of inventory purchased would increase the balances of inventory. That's why we are adding the purchases for the year. We don't know this figure, we need to calculate it. Less COGS, cost of goods sold, would reduce the amount of inventory. That is why we are deducting it from the balances of inventory. What is COGS? 50,000, right? It's given in my income statement, 50,000. And closing balance of inventory, which is how much? 50,000. Now guys, please calculate purchases. What is the purchases? It's the only missing figure.
1 lakh.
So we've calculated purchases. Now what we need to calculate is the cash paid to my suppliers, right? So to calculate the cash paid to my suppliers, I'll have to go to my payables account. So opening balance of accounts payable, which is 0 because we've just started business. Add purchases, because purchases would increase, credit purchases would increase what we owe to our suppliers, which is 1 lakh. Less cash paid to suppliers, this is something that we need to calculate. Okay, so cash paid to suppliers is something that we need to calculate, and cash paid to supplier is deducted from my accounts payable, because cash, if we pay cash to my suppliers, then that would reduce what I owe them, right? And closing balance of accounts payable is what? 80,000. So guys, cash paid to suppliers has to be
20.
20,000. Okay, so now I report uses of cash. Cash paid to suppliers, which is okay. Okay, now guys, next thing we need to calculate is the salary paid in cash, right? We need to calculate the salary paid in cash. So we first uh, uh, we write down opening balance of unpaid salary. So since we've just started business, opening balance would be 0. Then salary due for the year. This we find in the P&L. Salary accrued for the year, which is 25,000, less salary paid in cash. This is something that we need to calculate, right? Which is something that we need to calculate. So any salary that has accrued would increase your balances of unpaid salary, and any salary you pay in cash would reduce the balances of your unpaid salary. Closing balance of unpaid salary. So closing balance of unpaid salary is 5,000. So what is the salary paid in cash, guys? 25
20.
minus 25. So that is my missing figure. So salary paid in cash. How much? 20. And last thing that we need to calculate is the interest paid in cash, right? And how do we do that? So let me just copy this. Opening balance of unpaid interest, which is 0. Add interest accrued for the year. This we find in the P&L, which is how much? 5,000 less interest paid in cash. कितना आया? We don't know that. We need to solve for this, right? And if you add interest accrued and deduct interest paid in cash, you get the closing balance of unpaid interest, which is how much? 2,000. So interest paid in cash is how much, guys? 5,000.
3,000.
3,000. Interest paid in cash. So this is okay, guys. So we have our CFO, which is, if I sum all these, right? If I deduct the uses of cash from the sources of cash, I get my CFO, which is 7,000. So this is my operating inflow. Okay, guys, are we good? This was our CFO, which we had calculated after looking at all these transactions. Right, guys? My CFO was how much? One second. Yes, so my CFO was 7,000, guys, here. So I've unhidden everything. My CFO is the same figure, right? I've still got the same figure. Okay. Okay, guys. Now, how do you calculate your CFI, guys? So we've been given that the depreciation expense is 25,000 and the closing figure balances of plant and machinery is 475. So how do you calculate the amount of machinery purchased during the year? So it's calculated in this fashion.
Opening and
Again, same thing. Opening balance of P&M, which is nil. Add purchases for the year. This is something that you need to calculate, right? Less depreciation, right? Which is 25,000, and closing balance of plant and machinery. So to the opening balance, if you add purchases of plant and machinery for the year and reduce depreciation, you get the closing balance. Closing balance is given to us, it's 475, right? So the purchases for the year has to be 5 lakh, right? 5 lakh minus depreciation is your the closing balance of plant and machinery. Yes. So my CFI is going to be minus 5 lakh, right? Guys, are we good here? Anyone's having any doubt?
No, sir.
And guys, then you can calculate the financing cash flow in the similar manner. Are we good, guys? So we've seen two ways. First, you know, this is how we actually, uh, this is how it's actually done in companies. As and when each transaction happens, it's updated in the books of accounts and the income statement and The balance sheet are being prepared simultaneously, real time. They are being prepared on a real time basis, right? But this is what happens within. This is what is done by the accountants within a company, right? Uh, but in the examinations, in advanced examinations, not in CFA examinations, but in advanced examinations, you'll never get to know of all this. You'll never get to know of these transactions here. All you are given is your balance sheet and income statement, and from that balance sheet and income statement you need to prepare the cash flow statement, right? And the cash flow statement would basically reconcile the opening and the closing balances of cash, right? So we saw these from two perspectives, right? The first perspective was that I was telling you the transactions the company was doing, and from that we were creating the income statement and the balance sheet. Now what later on what we did, we removed all those transactions. We thought, okay, we do not know the those transactions that happened. What we are given is only the income statement, what we are given is only the balance sheet. And how can we prepare the income, how can we prepare the cash flow statement using that income statement and using that balance sheet without any knowledge of these particular transactions? Right, guys, are we good here? Any doubts, please? Are we crystal clear?
Yes, sir.
बोलो किसी के मन में कोई, स्पेशली दी साइंस गाइस, शिवशीष अंकुश बोलो.
Sir, in accounts payable, if uh, we are like paying directly to suppliers and not on credit, तो कोई दिक्कत नहीं होगी उसमें.
क्या क्या कह रहे हैं?
हम्म,
हाँ, अगर पहले ही पेमेंट कर दिए क्या,
हाँ.
तो वो सब इसी में आ जाएगा, कैश पेड में ही सारा आ जाता है, ठीक है ना?
ओके. हाँ.
जो जो कैश परचेज भी किया ना संकुश, वो भी इसी में आ जाएगा, फिर कोई दिक्कत नहीं आएगी, ठीक है ना?
हाँ. ओके.
जब
हाँ.
कैश सेल भी करेगा ना, अगर ये सेल्स अगर सपोज कर, यहाँ तो आई टोल्ड यू दैट इट वाज अ क्रेडिट सेल, बट सपोज यू डू नॉट नो वेदर दिस इज अ क्रेडिट सेल और अ कैश सेल, ठीक है ना? बट यू नो दैट दिस इज अ सेल, तो ये कैश रिसीव फ्रॉम कस्टमर्स में एनी कैश फ्रॉम कैश सेल्स इज आल्सो इंक्लूडेड. ये कैश रिसीव फ्रॉम कस्टमर्स में ना संकुश, एनी सेल दैट इज अ कैश सेल इज आल्सो इंक्लूडेड, ठीक है ना?
हाँ. Yes.
Because in the income statement, in the balance sheet, and guys, also in your footnotes of accounts, companies do not disclose their credit purchases and their credit sales. This is something that is not disclosed in the books of accounts. In very rare cases you will get to know these figures, right? In very rare cases you get to know the credit sales and the credit purchases of the company. So that is why you have to monitor the accounts payable and the accounts receivable. So if your accounts receivable are growing, then naturally that means that the company is selling goods on credit. And if your accounts payable is increasing, that naturally means that you are buying goods on credit. So you need to watch out for these two accounts in the balance sheet to gauge whether the company is buying and selling on credit. Because hardly, very, companies never disclose what their credit sales are, what their credit purchases are. Okay, चलो, any doubts guys? बोलो, बोलो guys, कोई doubt?
No, sir.
Now guys, I want to tell you a particular example. You know, where you need to calculate the sales. The price at which you sold an asset, and the price at which you have sold an asset becomes a part of your CFI inflow, right? But the CFA Institute has given a number of complex questions as to how to calculate the sales price of an asset sold, right? So I'll give you the question first, and then I will explain how we solve for it, right? So that will become much easier to explain, and most probably we'll end the class very fast as well. Okay. So there is a company which has reported a gain on sale of equipment. It has reported a gain on sale of equipment of uh, 12 million. ठीक है ना, तो रुपीज मिलियंस लिख लेते हैं, आज डॉलर में बात नहीं करेंगे, बहुत हो गया डॉलर का. Okay, in the income statement, the company has reported a depreciation expense of 8 million, and in the cash flow statement, the company has shown a capital expenditure of 15 million, all of which was for the purchase of a new equipment. So purchase of new equipment is 15, right? So basically 15 million has been spent to purchase a new equipment. Okay, and guys, here we have the gross block. Gross block at the starting of the year is 109, ending of the year is 100, and accumulated depreciation is 36 and 30, and your net block is gross block minus accumulated depreciation.
सर ब्लॉक मतलब
अभी सब बताओ. Now your question is, the question is that, see, some asset has been sold during the year. We have to calculate the sale price of the asset sold. Okay, so see, there has been a gain on sale of equipment, so that naturally means that some asset has been sold, right? We need to calculate the sales price of the asset sold, and this sales price of the asset sold is going to be a CFI inflow or an investing inflow. Okay, so now I'll explain what gross block is, what accumulated depreciation is, everything else, right? Okay, so let's start with the discussion of what is gross block, what is accumulated depreciation. Okay, so guys, what is gross block? Okay,
After
now,
deducting the salvage value.
no. So gross block basically records the original cost of the assets the company currently holds. Please write this down. Later on you might forget this, because this has not been explained very clearly in the CFA Institute or in the Spicer mat. So please write this down. Gross block records the original cost of the assets the company currently holds. Original cost, right? Original cost was the purchase price plus any delivery and installation cost plus any other costs that were necessary to get the asset ready for use, not get. Okay, so so any other cost necessary to get the asset ready for use, right? That is my original cost, and the gross block basically records the original cost of any asset that the company currently holds, right? And guys, one point to remember here is that land is not a part of your gross block, right? Land is never a part of gross block, because land is never depreciated. So land would never be a part of your gross block. Only building, plant, machinery, furniture, fixture, vehicles, um, air conditioners, all that would be a part of your gross block, right? Because only these assets that I've just named are depreciated, right? So all assets that are fixed assets, all non-current assets that are subject to depreciation are reported in gross block, but they are reported at their original cost, right? They are reported at their original cost, and the original cost is the price at which we purchased these assets many years ago, right? Okay. So guys, how do we reconcile the opening balance of gross block and the closing balance of gross block? Right. So first look at this. Reconciliation of opening and closing balance of gross block. Opening balance of gross block plus original cost of asset purchased during the year less original cost of asset sold during the year. Right, so you add the original cost of the asset purchased during the year, you deduct the original cost of the asset sold during the year from your opening balance, you get the closing balance. Guys, are we good with what gross block is? Bolo guys. So
Yes,
this
sir.
100 million is the original cost or the price that the company pay to buy these assets that it currently holds, right? It's the cost at which the company bought these assets which it currently holds, right? And any assets that are sold are not a part of your original cost, right? Okay, are not a part of your gross block. Next, guys, what is accumulated depreciation, guys? Any idea what is accumulated depreciation?
Total depreciation till now.
Total.
Yes, it's the total amount of depreciation charged
Total.
on the fixed asset since it was purchased. So, guys, say we purchased an asset on 1st January 2014 at 1 lakh. The asset has a useful life of 10 years and a salvage value of 0. What would be the accumulated depreciation 5 years after purchase? That is on 31st December 2018. What would be the accumulated depreciation after 5 years? The asset was purchased at 1 lakh. It has a useful life of 10 years. Salvage value at the end of useful life is 0. So, what would be the accumulated depreciation on the asset after 5 years?
50,000.
50,000, because the annual depreciation expense would be 10,000. Asset has been used for 5 years. So, the accumulated depreciation is 5 into 10,000, which is 50,000. Okay, so the basic idea is, guys, that every time the company charges depreciation on the income statement, the accumulated depreciation account increases by the same amount, right? And guys, how do we reconcile the opening and the closing balances of the accumulated depreciation account? Please understand this as well. So, opening balance of accumulated depreciation plus, or you add depreciation for the year, right? Depreciation in the current year. You'll find this figure in the income statement, right? Current year depreciation is expensed in the income statement. Less any accumulated depreciation on assets sold during the year. Any accumulated depreciation that on the asset that is sold during the year is deducted from the balances of accumulated depreciation, right? And once you add the depreciation in the current year and deduct the accumulated depreciation on the assets sold, you get the closing balance of accumulated depreciation. Okay, guys, are we good? Guys, are we good or not? Please tell me.
Sir,
Yes, sir.
sir, accumulated depreciation on assets sold during the year we deducted. Means after, when we are write off that asset, we are also writing off that
Yes, once we are selling the asset, we are also we are basically removing the original cost of the asset from the gross block, and we are removing the accumulated depreciation on the asset sold from the accumulated depreciation from, दोनों को ही हटा दे रहे हैं, उसका original cost is also being removed and its accumulated depreciation on the asset being sold is also being removed, है ना?
ओके ओके
ठीक है सुप्रतीक?
ठीक है सर।
Okay, now we have to calculate the sale price of the asset sold. So sale price of the asset is what? It's the carrying value of the asset. Carrying value of the asset is what? Original cost minus accumulated depreciation. So to calculate the sale price of the asset sold, we have to calculate the carrying value of the asset sold. And carrying value of the asset sold is the original cost of the asset sold minus accumulated depreciation on the asset sold. Right. So your sales price is the carrying value of the asset sold plus any gain on sale, or you deduct any loss on sale. So what is the idea, guys? The idea here is that if you are able to sell the asset at a price which is higher than its carrying value, that is, if your sale price is greater than the carrying value, you make a gain, or if your sale price is less than your carrying value, you give a loss. Guys, are we good here? Any doubts, please? Anybody's having any doubts with what I just told you?
नो सर।
If you sell the asset at a price which is greater than the carrying value, you make a gain. If you sell it at a price which is lower than the carrying value, you make a loss. ठीक है ना? Because you can think that your carrying value is your cost. If you sell it above cost, you make a gain. If you sell it below cost, you make a loss. Right. So first, guys, now to calculate the sales price of the asset sold, we need to calculate the carrying value of the asset sold. How will we calculate the carrying value of the asset sold? First, we'll have to calculate the original cost of the asset sold. How do you calculate the original cost of the asset sold? We'll calculate it from the gross block, right? This figure here would tell me the original cost of the asset sold. Okay, so first we go and see the opening balance of gross block, which is 109. Then original cost of the asset purchased during the year, that's given to me 15. Assets sold during the year, original cost of the asset sold, I don't know. Closing balance of gross block 100. Guys, what would be this figure? Please tell me. 109 plus 15 minus 100
24.
minus. So I have this figure. Now we go to the, we need to find next the accumulated depreciation on the asset sold. Okay. So accumulated depreciation on the asset sold would be first opening balance of accumulated depreciation, which is 36, plus depreciation for the current year 8, less accumulated depreciation on the assets sold during the year. We don't know this, we need to find this. Closing balance of accumulated depreciation is 30. Right, so now this is the missing figure. The missing figure is your accumulated depreciation on the assets sold, which would be 36 plus 8. That is how much? 44. 44
14
minus 30 is
14
14. Right, so right, guys. Now, guys, what would be the carrying value of the asset? We've calculated the original cost of the asset sold. So the asset was purchased at 24 million several years back, and the total depreciation charged on the asset since it was purchased was 14 million. So the carrying value of the asset is
10
24 minus 14, which is
10
10. What is the gain on sale?
12
Are we good, guys? Have we calculated this? Are we good here or not? Please tell me.
yes sir।
Good.
Okay, guys. So that's it. That's more or less the idea. Now, guys, we have some time left. So, can we solve a question in class with respect to this? Are we good here? Shivashi, Sankosh, तुम लोग को समझ में आ रहा है चीज?
हाँ, yes, sir.
Shivashi,
Yes, sir.
तुमको? So, the
Yes, sir.
idea is that you have to calculate the sale price of an asset which has been sold. So, the sale price is the carrying value plus profit or carrying value minus loss. The idea is that if you can sell the asset above its carrying value, you make a gain. If you sell it below the carrying value, it's a loss. How will you find the carrying value? So the first goal is to calculate the carrying value. Carrying value is the original cost of the asset sold minus the accumulated depreciation on the asset sold. Right. So original cost of the asset sold is the price at which the asset was purchased many years back, and accumulated depreciation on the asset sold is the total depreciation charged on the asset that has been sold since it was purchased. So to total depreciation charged on the asset sold since it was purchased. So you calculate the two. How will you calculate the original cost of the asset sold? You look at the gross block account. I've showed you the reconciliation, right? And how would you calculate the accumulated depreciation on this asset sold? You will look at the reconciliation of the accumulated depreciation account. That would give you the accumulated depreciation on the asset sold. So you deduct the original cost of the asset sold from you deduct the original cost and the accumulated depreciation of the asset sold, you will get the carrying value. To the carrying value, you add the profit or you deduct the loss to get the sales price. Right. So that is the idea. Now, since we have some time, we started late only today. We did not start early. So we'll do one question, and on Saturdays or on Friday or Tuesdays class, we'll end this. We'll start with financial analysis, financial. Basically, we'll start with the ratio analysis in the next class. I'll complete the indirect method and I'll start with the ratio analysis part. Okay, guys, do this question please for me before I end the day. Loss on sale of equipment is 2 million. ठीक है? Depreciation expense for the year is 8 million. Capital expenditure, all of it was for the purchase of a new machinery, is 10 million. So I'm writing 10 only, right? I'm not writing million. Purchase of new machine. Chalo. Now, guys, gross block, accumulated depreciation. Gross block is accumulated depreciation. You need to calculate the sales price of the assets sold. Chalo karo. Do this and we are good for the day.
$15.
हाँ
Original cost of asset sold 15.
पता नहीं मैं क्वेश्चन अभी ये पुराना कैंडिडेट रिसोर्सेज से निकाला. Okay, so first we'll have to find the original cost of the asset sold and the accumulated depreciation on the assets sold.
13. 13.
So we deduct the two, we get the carrying value. To the carrying value, we'll add. Here we have a loss, so we deduct the loss on sale, and this will give us the sales price. So to calculate first we calculate the original cost of the asset sold, right? We'll be able to find it in the reconciliation of the gross block. So opening balance of gross block is 100 right? To that we add the original cost of assets purchased during the year, which is 10, less original cost of assets sold during the year, which is something that we need to find out. And if we add the original cost of asset purchased and deduct the original cost of assets sold, what we get is the closing balance of gross block. Okay, so closing balance of gross block is 105. So what is the original cost of assets sold? 100 plus 10,
15.
5.
5.
Fine.
So we've got the original cost of assets sold, right? So we've got this number here. Now we calculate the accumulated depreciation on the assets sold. For this, we need to look at the reconciliation of the accumulated depreciation account. So opening balance of accumulated depreciation, which is 40. You add depreciation expense charged in the income statement during the current year, which is 8, less accumulated depreciation on the asset sold, which is something that we've calculated. We've not, that is something that we need to calculate. And we get the closing balance of account, which is what? 46. So closing balance of accumulated depreciation would be for okay, accumulated depreciation on the assets sold would be 40 plus 8 minus 46, which is
2.
2, right? So the accumulated depreciation on the assets sold would be 2. So we deduct 2 from the
3.
original cost. What we get is
3.
carrying value of the asset is 3. And what is the loss on sale? 2. Sales price is 1 million, right? Are we good here, guys? Any doubts, please?
No, sir.
So this is
Good.
a kind of a complicated question that they might ask you sometimes in the examination. This has been, dealt very elaborately in the institute math, but they have not featured this in the Squeezer math. So most of us have an habit to read the institute, have an habit to read the Squeezer and not the institute. So that is why in today's class, I made sure that you are thorough with this, right? I made sure that you are thorough with this, right? So you have to calculate the original cost of the assets sold. You'll find it from the gross block. The gross block records the original cost of the assets that the company currently holds, right? And the accumulated depreciation on the asset sold is calculated from the accumulated depreciation account. Guys, notice one thing here. Notice this small thing. Once the asset has been sold, its original cost is being removed from the gross block and its accumulated depreciation is being removed from the accumulated depreciation account, right? So basically its carrying value is being removed from the books in such a manner. What was the carrying value? Original cost minus accumulated depreciation, right? So the as carrying value of the asset that is being sold is being removed in this manner from the books of accounts. Its original cost is being removed from the gross block and its accumulated depreciation is being removed from the accumulated depreciation account, right? So this, in this fashion, the carrying value of the asset that has been sold is being removed in from the books of accounts. ठीक है ना? Its original cost is being removed from the gross block and its accumulated depreciation is being removed from the balances of my accumulated depreciation account. ठीक है? Are we good, guys? Any doubts, please? बोलो, किसी के मन में कोई कोई भी छोटा मोटा डाउट भी हो तो चलेगा, पूछो. बाय.
No,
हाँ.
sir.